Welcome, everyone. I'm Angelo Robles, the host of the Angelo Robles podcast on Apple, iHeart, Stitcher, Spotify, and other platforms. And I'm the founder and CEO at FamilyOffice Association, a global membership organization dedicated to the interest of successful families and their family offices. I'm really excited about today's not only topic, but guest. And as I've had a chance this summer to work on so many thought leadership items, having a chance to work on our master classes where we do a brief discussion on some of the topics we're going to talk about today. And I think I noted I've been interviewing and researching many of our really, really big global families, like $10 billion and up, and understanding their risk, their concerns. And that all interplays into my thought leadership and my master classes that I do as I input what I learn around my skill and expertise and hopefully creativity and some of the great thought leaders that I get to talk to. You know, the topic that we're going to talk about today, the title of it, one of the most powerful tax and estate beneficial investment structures. And even that lofty title doesn't really do it complete justice, potentially to really all that it is. I know very, very few, like maybe none, other vehicles that kind of cover investing, tax benefits, if structured properly, estate and asset protection benefits within the confines of a trust, yet favorable access, very favorable, which we'll get to the resources, partially depending on the trust structure and how it's set up. There's very, very few. Again, I'm really only thinking of this that would really check the box on all of that. Many of you have heard of it and you're going to be vaguely familiar, but I think we need a refreshing. And by the way, the really big families, it's almost a part of all their portfolio, wealth preservation strategies, etc., any verbiage you want to do to it. It's a very, very powerful vehicle, both onshore here in America and offshore, even for American citizens, not necessarily as a tax beneficial play per se by being offshore, but there's other benefits potentially from an asset protection perspective. So what I'm talking about is private placement life insurance. It's not an investment per se, it's a specific vehicle. It's a structure, potentially for all those benefits that I noted. On that note, we have a true expert on the line now who's our special guest, and that's Brad Barros, co-founder of Private Risk Capital. Brad, how are you today?
Angelo, terrific. Thanks for having me on.
Yeah, I mean, I haven't given that lofty of an intro on a specific structure or subject. I don't know if ever. So you're getting the special treatment. So why don't I begin a little bit maybe off topic? So we had a great guest on yesterday, one of the true great tax experts and a global attorney. And we were talking about kind of looking at the tax picture. So to give some context, it's very early September in 2020. We're obviously in the midst of the economic turmoil of COVID-19, and we have the elections literally about 2 months away. And if the Democrats win, and I'm just looking at it from that tax perspective, don't look too deep into that comment, but the perspective is they've already have kind of made their proposal of likely what they're going to do. Raising ordinary income taxes, not a huge amount, but enough. Corporate taxes, capital gains, lack of step up, still keeping that 3.8%. There was hope maybe that would kind of fade away. So you're looking at people that may live in New York City or California, and they're just going to get crushed by taxes. We're not even getting into likely the lowering of the estate exclusion, an increased rate in the estate tax. This could be a little bit bloody from a tax perspective. So I know what you do in terms of your expertise on the structure known as private placement life insurance is potentially a way to help mitigate many of these challenges. Is that correct?
Angelo, it is. There's a variety of ways in which to do so, depending on each client's circumstances.
That is true. And like anything, and we always say this in the single family office community, one family or one family office, one, they're all snowflakes, and it varies depending on their personal, their tax perspective, their domicile, etc. Why don't I go very basic with you after we kind of laid that context now? Why don't you describe what would be the definition of private placement life insurance?
So it's a private placement contract. It said this is a private placement structure. This is not a this is an insurance policy typically designed to comport with the regulatory framework and the guidelines by the Internal Revenue Code and by the National Association of Insurance Council, the NAAC. And the effective structure of private placement policies can change depending on the family's need in the design of that policy. But these are insurance policies that, when done on a bespoke basis, carry a certain series of similar characteristics. The first characteristic is that we're for a U.S.-based family. Should I speak mostly to U.S. families, Angelo?
The podcast, if we produce it as such, is getting more and more of a percentage of international during COVID. But if I had to give you a ratio, Brad, 70% US and 30% offshore international.
Okay. So what I'm going to speak to are the standard benefits that a U.S. family would find. And that is the same types of tax characteristics that traditional life insurance has, meaning tax advantage growth, which in turn means no tax on the inside buildup in a life policy, tax-free access through withdrawals or very low-cost policy loans, or other mechanisms in which to borrow against holdings, and then a tax-free death benefit, which goes to the beneficiaries at the death of the insured or the insureds, and a step up in basis at that time. So there are more nuanced tax benefits, and there are non-tax benefits ranging from enhanced confidentiality, asset protection that's statutorily afforded by various state statutes, and a variety of other benefits for non-U.S. investors. What's really most interesting about your original question, which is describing PPLI, if I took a step back, Angelo, I begin with PPLI's traditional use in the hedge fund space. I think I've heard some of your podcasts before. Many of your families use hedge funds or have used hedge funds for investment. And the favorable characteristics of hedge funds are, when they're hot, they perform very well. The unfavorable characteristic is there can often be times when the fund is in and out of the market throughout the year, causing adverse tax consequences. So, these funds are fund clones, were developed inside of private placement policies. These are more to your question, these are non-commissioned, no commission, a low fee structure, wrapper, so to speak, as some people like to call them, that hold the hedge fund assets. Now, what we've been seeing families do for the last 20 years and more significantly so over the last 7 or 8 years, is to hold other assets in addition to the traditional bankable assets inside. So in a customized private placement policy that one would get with assistance from a global law firm working with us, they would have the ability to select their own investment management team. That could be the family office team. It could be an external team with a broker-dealer or an investment firm. It could be a team of trusted existing advisors that are approved by the insurance carrier. The same holds true with the custodian. So the client can select the custodian of choice. Is that a pretty good start?
Yeah, that's a good start. It was a little bit breaking up here or there, but we'll do the best we could. what I'll do is to give a little bit of context to that from my perspective. And to give further context, many decades ago, not that I want to give away my age, I was very active in executive benefits for Fortune 500 companies and working with things like COLI and BOLI as it's known. Often private placement insurance was a solution in there. So that lends a little bit to me understanding it. I'm not going to deny it's complicated. And one of the main reasons why many of you are familiar with it, but probably have done nothing with it, is because it just seems complicated and probably your advisors are not comfortable with their knowledge base. They just don't want to admit it. There's very few people that are true experts from legal, tax, and structuring perspectives. They're out there. Brad and his team is one, but there's relatively very few. At the heart of it, and don't be dismayed by this, it's a good thing. Yeah, it's life insurance. It's been around forever. It's very contractually friendly, incredibly beneficial benefits here in the US and around the world. And I guess you could say the core benefit is you're paying a quote unquote premium and getting a death benefit tax favored upon death. It's a valuable resource for the wealthiest of families to those that are more humble, that are replacing more of their income. Now, traditionally, Brad, where we'll take maybe a little bit of a step back if this is a little bit newer to some people, is, and you're also correct, there's potentially, depending on state, domicile, a variety of factors, some enhanced moat, what I call moat protection of the castle, wealth preservation, asset protection, and other tax favored benefits, which we'll dive into shortly. But when most people think of a cash value policy, they think of a traditional whole life. They have no control over the investments. It's done by the underlying insurer and gets a relatively very conservative internal dividend or return. However, in today's market, with traditional T-bills being incredibly low, that so-called a low return of the insurance company is really not so bad. But I think what really concerns people is it's incredibly not transparent. They don't know the cost of insurance. They really don't know anything. It's very limited, and that's frustrating to people of wealth and resources. The great thing about private placement life insurance is you have much more investment flexibility and control, and you have much greater, significantly greater transparency. Basically, the agent makes a hell of a lot less money. It's not like classic life insurance with their usual commissions. So that makes it transparent yet powerful as a vehicle. Why don't we talk a little bit more about the tax benefits? So you mentioned in, I guess, most countries, life insurance, the accumulation of the resources inside it are going to grow. Let's use the word tax deferred. We'll be a little more conservative. However, where it gets intriguing with life insurance is it's one of the very few vehicles, at least in the US, that allows FIFO, first in, first out, and then what's known as wash loans for the remainder, should you need access to the capital. Could you give us some context about that?
Sure. So when you think about it, Angelo, the client is going to have a portfolio of holdings. And typically in a bespoke policy, these holdings are going to include their LLC interests in their private equity, maybe the family business operations, portion of those holdings, partnership interests in real estate, and other holdings, all in a completely transparent insurance wrapper with a cost of insurance that is predefined and agreed upon. The ability to access these funds through policy loans is, as you pointed out, one of the inherent classic powerful characteristics of life insurance. So a carrier might charge 5 basis points to 35 basis points in order to access funds, which is 25, think of it as $2,500 per million at that level of loan. The client can borrow funds, typically depending on the structure of the policy and the trust that owns it, and they can use those funds during their lifetime. And then at the death of the insured, it may be, in the simplest way of putting it is, there's an offset between the cash value of the policy, which includes assets and loans to the client, and the loans that are the loans that are due. That at death, that integration does not trigger a tax attribution back to the family. So the client's been able to build up reserves over a lengthy period of time. And then at death, the beneficiaries will have the remaining cash value, and those can be paid out in kind. The LLC interest, partnership interest, et cetera, can go to the beneficiaries as they were. And then any additional reinsurance will be paid out to the beneficiaries tax-free, all of which can be done with a step-up in basis. And kind of going outside of the framework of this question, but to something you pointed out, there are a number of states where we can structure these so that we have statutory asset protection for Gen 2 or Gen 3, or even farther below, as well as Generation 1 that is the policy owner. So the liabilities that children or grandchildren may have may be protected from by having these policies go to them at mom and dad's death. And another point to that simply is, we have a wide range of individuals that could be held as the insureds, Angelo. So it doesn't need to be, often we'll have senior generation that's uninsurable, but we can work with, subsequent generations where the cost of insurance is much, much lower.
Yes, and that's something that we'll have a chance to dive into. So, yeah, I mean, that's the incredible power of life insurance. It's a very tax-favored death benefit. It's incredibly tax-favored if it's structured inside an ILIT or revocable dynastic trust for exclusion from estate tax purposes. And I don't know if we're going to do a super, super deep dive into that, because most of the value in private placement life insurance is going to be more theoretically while living. And the investment structure, or the structure of the PPLI, allows the internal investments to accumulate, because it is a life insurance contract, tax favored. And again, the access to that relative to first in, first out, and near wash or literally wash or favorable loans really just makes it an incredibly powerful vehicle with the transparency and the investment liquidity that we mentioned earlier. So let's talk a little bit about the underlying investments. So you did mention hedge funds. That was one of the more common ones, especially 10, 15 years ago. I don't know if you want to get really deep into the fact that technically these GPs with their funds looking for LPs needed to create insurance dedicated funds, which many of them have done. But then it started to go into more than just hedge funds. So lots of alternatives may, and there are certain guidelines, but may qualify as insurance dedicated or through other mechanisms to be placed inside, quote unquote, the life insurance policy, if you could elaborate.
Sure. So under Treasury Regulation 817H, we have a variety of holdings that can be included. And these can include everything from oil and gas leases to real estate to a variety of interests. We have clients that have holdings that range from something as broad as music catalogs for those who aggregate and then sell off those, to people who have film rights, intellectual property rights, patent rights. We have clients who have their portions of family businesses held within these policies, aircraft and yachts that are income producing in these policies. All of the assets I've described generating K1 income and other profits inside the policy that's earned tax advantage in the policy with the attributes we discussed. There really is, probably the greatest core strength of the product per se is that ability to have assets held worldwide in the name of an insurance company on behalf of a segregated, statutorily protected fund inside of the carrier in this policy. And then the ability to invest. And Angelo, the investments can be, as I've alluded to, not only domestic, but international. So a client could have, by example, their investment management team at Goldman Sachs handling a portion of their domestic portfolio. And they could have Pictet or Bank Julius Baer in Zurich managing their European currencies, the Swiss francs, their gold, things like that. They could have holdings in Latin America that are held, managed by a team of experts in that part of the world. So the beauty and the efficiency is this ability to have professional advisors managing in concert with one another the entirety or a substantive portion or a layer of the substantive portion of holdings that a family would have generation to generation in a confidential, asset protected, tax protected, U.S. compliant vehicle, or a vehicle that's also compliant in one of many other jurisdictions around the planet.
So, in terms of the investment flexibility, which has gotten better, I guess you could say, or more expansive in the last couple of years. Again, it used to be, stocks and hedge funds, and now it's more inclusive. You mentioned some of them. Now, there are certain guidelines or arguably restrictions, and it needs to be carefully done. And again, this does take the experiences of an attorney, nuanced, not just in tax and estate matters, but really probably experience, well, not probably, let's go with yes, in private placement life insurance. And again, there's not a huge number of them. It's relatively a limited number, but some of the types of holdings that you mentioned inside a private placement life insurance contract, did any of that require a level of a PLR from the IRS or legal opinion?
So most of our clients, certainly not a private letter ruling, the rules and regulations are very clear. And I want to go back for a moment to something you said. The assets that I've described have been placed inside of these types of policies for, in my own personal experience, for the last 22 years. So my team members and I have been doing this kind of work going back that far with family holdings, national franchises, all sorts of business interests. The difference is that there are, and then I'll speak to the question regarding the lawyers. The difference is that if someone's going for a sort of an off-the-street product, something they might buy through their investment management firm, or even though it may be very low priced and efficient, a sort of a global carrier that puts together packaged products of insurance dedicated funds that have hedge funds in them. Those types of products are typically distributed through financial advisors and brokers because they do pay a commission, they pay a specific referral fee, and they're easily packaged. What I'm speaking to is the kind of work that when one goes to the right team at Baker McKenzie or another global law firm, U.S. and non-U.S. clients, then a customized approach can be created that can allow the family to invest in the same assets and types of assets that is otherwise investing in presently. And often we will have, clients will want an opinion or something called a top opinion, in that a sister law firm of ours will draft the opinion, and then a global firm will come behind them and write a confirming opinion. I think clients like that because there's an absolute level of protection against any. And when these are done right, we have a regulatory standpoint. And that's an important part, to make sure that the client's existing legal team and accounting team are working in concert with the experts at these global law firms, and that they're providing, and that together they're providing an overview so that the client's investment management team or independent management team can actively purchase and sell and manage the holdings in the family's policy.
Yes, that is very, very true. Again, we do not have a great connection, but I think it's good enough. So those that are live, hopefully I'm sure, are watching it on video, still going to be value, but excuse us for a little bit of the Wi-Fi or the technical glitch. I mean, again, we can make this a 6 to 8 hour masterclass and cover every little nuance. We're not going to do that. We have ballpark in total, and we're almost halfway through approximately an hour. But there is a level, there's a lot of science to it, but there is a level of art. So there is a level of art plus science into the design and the right structure. And the great part is these could be very flexible structures if you're utilizing it more so from the perspective of you have alternatives that may not be taxed favorably, and you're looking for tax-favored growth and tax-favored access. That's different than maybe certain trust and structures you would do where it's more leveraged for death benefit or for charitable purposes upon death. Again, we could do super deep dives into various types of trust protectors, how to get potential access, but that's a deep estate planning dive in a topic like this, which could be incredibly complex and again, could go on and on. So just understand the things that we spoke about so far, these are the reasons why, although most families above 100 million are aware broadly of private placement life insurance and or variable annuities, they haven't gotten comfortable, or their advisors just have not, which is a shame because it is a very, very powerful vehicle. Brad, many of the families have heard about the opportunity to finance their premium, meaning at the levels we're talking about, there's significant premiums here. Is it possible in private placement life insurance to utilize premium financing?
Absolutely, Angelo. So families can use their existing sources of capital, and then there are separately a variety of different funders and mechanisms that are available as well. These include domestic funding, and until the recent significant downturn in U.S.-based interest rates, our clients were borrowing money at nearly single basis points from, say, lenders using Swiss francs as a platform, which can still be done, although that would entail a bit of currency risk. At the current rates in the United States, we're watching clients or observing clients who may not be using even a relationship bank, just a lender that has an expertise simply in the space, lending at 1.8, 1.85% presently, with the ability to lock in funds. I also think it's important, we're talking about funding, that there are sort of two different paths when it comes to funding a private placement policy. The first path, let's call that the traditional one, which is the client wants to put assets in the policy, and the client transfers assets. They could be assets in kind. It could be cash. In either case, those assets are in the policy, and they could be financed, and those assets are in the policy, and they grow. And as long as the policy is operated properly and stays in force, there won't be tax. No tax on K1 income, no tax on other profits, no tax on capital gains, no tax at death. The second type of funding, Angelo, is where the client is looking to acquire holdings at the initiation of the policy. Interests in a real estate portfolio that the client may otherwise have ownership in, or some other assets. Maybe it's an operating business that the client has, and the policy is going to own a portion of that business. In that case, the client needs to fund the policy with enough money so that the policy can engage in a transaction to acquire over a period of time, a portion of those holdings. It's a more complex discussion than we'll get into on today's phone call, but doing so doesn't necessarily require a transference of a great deal of assets or wealth into a policy. It's essentially think of the concept of priming the pump in order to be able to enter into a leveraged buyout of a portion of a family's holdings.
Yes, and that's a very deep perspective in terms of what you and your talented team in terms of do. And you're correct. It's hard, especially without graphs and diagrams and more time, to do it justice per se. But hopefully the core perspective of it goes through. A little bit on the investing side. So, most American citizens are likely going to structure these domiciled here in the U.S. via a trust, probably a South Dakota, Nevada, Delaware, New Hampshire, Alaska, no state tax, more favorable privacy protection rules, possibly a little bit more asset protection. But on the investment front, if they're looking to be incredibly diverse with alternatives that are offshore that don't have U.S. operations, likely they're going to be a little bit more hand-tied. But if they were to structure it offshore, they may have additional investment if that's what they want. Maybe all they need is here, so that's not needed. But would you say there may be some more additional investment flexibility if it's structured offshore?
So the level of investment flexibility for a U.S. citizen is going to be broad either way. There has to be some diversification of assets, and that is imposed by the code, and there are regulations that we need to be aware of when investing. But for example, you mentioned that this is an art in addition to being a science. So we have clients who have large portfolios of artwork.
Literally.
Yes. Now this shouldn't be the art that's, in the dining room wall, or, I walk into a family office and there's a $30 million painting in the boardroom. Typically, this is the art that's held as part of a collection, where clients used to be able to do 1031 exchanges, for example, and they would do these exchanges as they traded their art portfolios. That's no longer possible under the latest tax code revisions. And so envision the efficiency of one's art management team managing buying and selling artwork without any tax whatsoever inside of an insurance policy. And you also kind of tying back, going back to the costs, these policies could have an ongoing cost of insurance of 17, 15 basis points a year. So that cost is much, much lower than any tax that would be applied to a gain on a policy. Lastly, to your point about investments, clients who don't want to do a 1031 exchange with their real estate, they could have the profits interest of a property that could potentially be held inside of a private placement policy, so that there is no tax on gain when properties are bought and sold by the managers of these funds. Continuing down that path, startup companies, unicorn investors, businesses where we're looking to buy it at a low value in the policy and then later sell at a high value. When the independent manager buys and sells those properties, Angelo, again, there's no tax in the policy. So the code gives us a great latitude. We're looking for something that has where value can be established, but it doesn't have to be in a traditional investment.
Very good points. I mean, I would, I guess, make a little bit of a case. And lately, I admit, mainly in my research this summer, my little mini sabbatical, my talking with the $10 billion families, not all of them US, some of them international, I have become a little bit of Mr. Offshore lately. I will admit that. One of the challenges potentially, one, I believe the cost offshore with the DAC, the deferred acquisition cost and cost of insurance, may be a pinch less, but that's relatively modest. But depending on the domicile where the trust is, and that does not mean that that's where the assets are, but theoretically, likely where they did their blood test and application for insurance and structure their trust offshore, whatever, BVI, Bahamas, Nevis, Cook Islands, etc., you are going to get directly and indirectly greater privacy and asset protection. It's not a tax play per se for the American citizen, although inevitably the life insurance contract itself and the structure is greatly tax beneficial. But in a litigation circumstance, it's way harder in those other countries and much more complex for a party here in the US to really go there and win and then win the judgment and get anything from it, really, really difficult. Not to get a little bit too weird on the audience, but potentially, even in states that are more favorable here in the US, Delaware, Nevada, there's potential for it to be called fraudulent conveyance. And the look back, I think, could be as long as 7 or 10 years, where in some of those offshore destinations, not necessarily. Now, again, I don't want to make this a very in-depth tax perspective, what would happen. And again, if it's a US government issue, then you probably have no hope. But from other litigators, I'm going to say that you're going to get an additional layer of protection in an offshore structure. But how many families is that really going to be applicable for? It's a little debatable. I guess the bigger question that I have for you, Brad, is let's say someone looks at this as being great. This is valuable. I get it. I want to do something. But technically, it is an insurance contract. So there's a premium that's going to be paid applicably for a death benefit. In other words, there's only so much of a death benefit that someone could get. And in today's COVID world, with maybe reinsurers being stressed out a little bit, what is the maximum amount of insurance within a PPLI contract that, say, an average healthy 50 or 60-year-old is potentially going to be able to obtain?
Well, it's a great question. And the answer is, as I begin to smile before I give the answer to you, is it all depends. So in a traditional setting, we have clients that have, several $100 million of life insurance on each of the lives of 2, 3, 4 family members. That's not uncommon. We've done a case with over $1 billion of death benefit.
Wow.
So it really depends. Now, I will put an asterisk on this and say that in a post-COVID era, that reinsurance, if we're staying within sort of the traditional view or the traditional US-based life insurance model, reinsurance can be more difficult to get. Carriers that would have issued a policy with a mild rating or a moderate rating today will simply decline an insured regardless of the size or potential profitability of the case. And I see that ebbing as we get beyond, the earlier part of this year with COVID. But sometimes that can be a problem. Now, there's a second type to the point I was making when I began my answer. There's a second type of insurance that we do a significant amount of work on, and so do some of the law firms that we work with, and that is something called frozen cash value insurance. And with frozen cash value insurance, the amount of death benefit that a global law firm will require is often only about 5% of the amount of the premium that goes into the policy. So if a family that was a billion-dollar family were to put a $50 million or $100 million portfolio into a frozen cash value policy, they'd only need $5 to $10 million of life insurance when they took out the policy. Now, there are a number of law firms which have done some advanced types of planning, and we'll do something called prepayment of mortality. So I could have a $100 million portfolio in a policy and a $5 million death benefit that's essentially prepaid at the time of premium. All the assets are invested by the family's advisors as approved by the insurance carrier. And that 5% ratio floats with the other funds that were paid as premium, if you're following. And so I always maintain that ratio, and I continue to receive the tax treatment from the IRS that I'm looking for, so that this remains a compliant policy. And each year, some of the firms that I've mentioned already on this podcast, those firms will opine and continue to support that everything is being done in a proper way for the client. So sometimes mortality can be challenging. Sometimes we can use frozen cash value. And sometimes, Angelo, on an even more sophisticated basis, we'll use synthetic pools, and there are other ways of getting around the problem. So maybe the direct answer to you is that there are limitations with traditional reinsurance underwriting, and when we run into those headwinds, we have a significant bag of tricks to, and when I say tricks, I mean we have a significant series of compliant options, but thoughtful ways of getting around those problems that you might envision we would have working with, global law firms.
Yes, indeed. And I suppose that relates a little bit. You did hint at it earlier. What happens if, and I'm again making this up, someone's in their 70s, they see the value in it. Let's just assume they're uninsurable. Do you then look at their spouse? Do you look at a children, a grandchild? And again, it may have a different perspective. Are you leveraging this more from a death benefit perspective or from let's broadly call it an investment in tax more favorable perspective? So it is going to vary, but is there nuances and flexibility relative to insurability?
So the answer is yes. And, it may be that we need to go to a synthetic death benefit or a frozen cash value policy where I'm not relying on the insurability of the senior generation whose death I want to trigger the tax-free passing with a step-up of basis to subsequent generations. We've also developed and there are others out there. We're not the only bright guys on the street. There are a number of creative people who are very capable and trustworthy that are out there. But there are techniques that we and others have developed that are specifically designed for members of a senior generation who are uninsurable, so that the assets can be maintained and controlled by them during their lifetimes, and then passed at their death to their children or grandchildren without estate tax, without a capital gain or gift tax. And these are transactions that are typically handheld by a national or global law firm in order to achieve the result. So a variety of techniques for the client who knows who to go to when it comes to getting advice, because this is a very specialized area.
And you hinted at it already, but I'll ask it. Let's just assume someone's in their 60s. Let's make the assumption the most they could get through reinsurance is $150 million, but they already have $90 million of life insurance insuring their lives in various trusts. Do they just have to accept they can only put in the amount of money to justify a $60 million policy in my example? Or is there a way to do an exchange or other that could allow them to effectively replace what they may currently have so they could have a private placement policy for a larger amount than I gave in my example?
So the answer is that they can integrate, and not only that, they can take their existing life insurance that's either already been paid for or they're presently financing or funding, and they can integrate that. They can essentially repurpose it so that it becomes all or part of the death benefit of the private placement policy. There's a whole series of techniques developed by very experienced attorneys and professionals in this space that allow us to do that. So oftentimes a client will come to us and they're spending, whether it's $500,000 to $6 or $7 million a year in loan interest on their existing life insurance to cover estate tax, and we can literally shift that expense to the private placement policy. And as we've already discussed, these private placement policies are much more tax efficient than any individual or an LLC that might otherwise be acquiring life insurance today. So there's a variety of secondary and tertiary benefits and cost savings that can come from appropriately using these types of transactions.
Let's go back to something we touched a little bit upon earlier, kind of the investment options, and probably the most common, if I could call it an alternative asset for families of wealth, is going to be real estate. Could you give us an example of how real estate may be applicable inside a private placement life insurance policy?
So think of real estate as any other holding in a policy. If I have residential or commercial holdings, the rental income that comes from those holdings is not going to be taxed inside of the policy. Insurance policies have a have a special way in which they're taxed under 807. And in short, the insurance policy, that income not only grows in the policy, but gets to be reinvested by the client through their investment management team into other real estate holdings or other holdings, other private equity, on a continued tax efficient basis, with very, very little friction, but for the definable, measurable expenses of the policy. I mentioned earlier 1031 exchanges. A lot of times when we many of your clients, many of your members, many of our clients are large real estate holders, and some of them pay very little or no tax at all on their real estate portfolios, and often there isn't necessarily a connection for them to want to transfer a portion of those portfolios into their policies. But inevitably, there is a situation where that same family has a property that has a large gain that's built into it. They don't have negative basis, and they are looking to, but they also don't want to do a 1031 exchange, Angelo. So by having by having their PPLI policy hold a real estate that is sold by the policy within the policy, we avoid the tax that would otherwise come from by not having the 1031 exchange. And again, we get the same death benefit transfers and step up in cost basis as one might at death if they were holding real estate. Now, one neat benefit about this is that you were initially alluding to the potential changes coming January 1, given the possibility of a Biden presidency. Those changes are likely going to be focused on traditional tax methodologies. They're not likely going. There's nothing that we see. There's no evidence that the IRS has any interest in changing the way that life insurance is taxed or treated for individuals. So it's even more protection from that standpoint.
Very much true. And not only a very strong lobby and valuable as a resource to so many families, including obviously, working class and middle class families, providing a tax favored death benefit when it's needed most by that family. You never know, never say never, but it's been tremendously beneficial for probably well over 100 years now. And I don't think, again, always a little bit of hesitation, I don't think we'll be seeing that change anytime soon. And I know we're bouncing around on such a complex subject, but I'm putting on my Mr. Offshore hat again. So could you help and design and implement for someone who's a U.S. citizen, but they want to have their trust and they want to sign the application, have it be officially offshore, and they want to use a bank or a resource in Switzerland, which there are probably a little more flexibility relative for being an offshore entity. You can make the argument, though, it's still an American citizen, but like a bank like Vontobel also has a U.S. RIA operation, but a lot of the resources and assets are custodied, literally held in Switzerland. I'm assuming what I'm saying, which if I had to simplify it, U.S. citizen, yet offshore PPLI, and investing in the proper mix and variety of assets in Switzerland would appear to be okay, or does the U.S. citizenship part nix that?
No, it's not only does it appear to be okay, but it's something that's done in our space on a daily basis, whether it's Vontobel or it's any other major Swiss bank. A lot of our work lately, for example, has been working with families that have one foot in the U.S. and another in Hong Kong or Singapore, where there's an emergence of added concern with what's happening in Asia. And so the ability to move assets between different tax regimes in the name of the insurance company on behalf of the policy, as opposed to in the name of the family. So we have added confidentiality, and we have a number of families, for example, in Latin America, who are concerned about kidnap and ransom. They don't want others knowing their wealth. Well, policies can be structured so that the wealth is viewed from a reporting standpoint as death benefit, as opposed to a cash value bank account that's showing up somewhere that might cause concern for the family. So whether it be for tax purposes or compliant confidentiality, being in the US or Zurich or Tel Aviv or the UAE, all of those work, and we work with families who we actually work with families who have assets in all of those jurisdictions within the framework of their private placement policy structure.
Very true. And I'll actually say something on the opposite perspective. So for those that are non-US citizens that may be listening in and being international, I'll reverse roles a little bit. Again, yeah, of course we have challenges here, but other countries have often greater challenges than we have, and they've seen greater upheaval. So the opportunity of a US-centric trust and assets resourced here could be of value. I'm not going to dig too deeply into this, but I'm probably going to get in trouble for my next comment a little bit. Most of the world outside of the US, I think you know that in the EU and most of the world, there's shared tax information by countries. It's really hard to be a little bit discreet. The US currently, may change in the future, does not share information with other countries, which is why you see foreigners set up structures, LLCs, and trust and private trust companies in Delaware, in South Dakota, in Nevada, and potentially PPLI could be an option for them in the United States because it kind of keeps some of their assets and resources a little bit off the grid given their country. Again, let's probably stop it there on that. But again, I'm showing you there's a lot of global complexities here to that moat around the castle and the value of applicable trust and quote unquote insurance, and in this case, PPLI. Brad, let's talk a little bit about, I'm assuming occasionally these get the attention of the IRS and may get an IRS audit. How have you seen that play out?
So, in our experience, we've had a handful of clients that have ranged from, entrepreneurs and unicorn investors to hedge fund owner managers who've had capital accounts and carried interest inside of their policies. And I've never had, none of my team have had an adverse tax outcome with any of our planning. In part, that's because we build these assuming, even though audits are hugely infrequent, we build them assuming there's going to be an audit so that everything is put on the table and can be defended. That's why we get firms that like those that I've mentioned, Baker, McKenzie, and Withers, that, opine on behalf of our policies, our structures, and will opine for clients. But I don't want to leave the opportunity to touch on something you said first, which was sort of if somebody is an international investor. One of the neat benefits of PPLI for an international investor who's investing in the United States is that typically when, say, for example, real estate is sold and there's a capital gain, you may be familiar, Angelo, that if I'm a Mexican national, there's a withholding tax, for example, or if I'm from some other part of the world. Uncle Sam wants to make sure that the foreign investor doesn't take their capital gains and go before Uncle Sam gets his, capital gain tax deployed on the assets. However, when that investment in the U.S., that real estate portfolio is sold in a policy, in a compliant policy, there is no withholding tax and there's no FRIPTA. There's a much lower level of reporting obligation back because it's done in the name of the policy. So there we'll use, for example, a hybrid insurance company where it's a U.S. company for federal income tax purposes. The assets are in the United States for the most part, but it is a non-U.S. company for regulatory purposes. But all of that fits square within the codes and the statutes. So clients can have benefits on both sides of the Atlantic or Pacific in this case.
Yeah, I mean, as we're, talking, I could only, imagine the listeners, whether live or listening in. I mean, this is complex. I gave you that warning going into it. Hopefully you learned a little bit from it, and something you may want to follow up on. It does take the right mix of legal, tax, insurance, possibly even someone quarterbacking or consultative in this process. It is complicated. Yes, I agree with you, Brad. Baker McKenzie, specifically one or two people in Zurich in Switzerland, are just tremendous. Withers Bergman with operations here in the U.S. We had Ed Wren from Withers on yesterday on tax issues, and they're one of the most iconic global organizations for complex tax issues. I mean, this is really important. This is, to some degree, again, what I've been working on all summer, my conversations, my research with the biggest substantial families. They're already rich. They could be rich for generation after generation, in theory, with zero investment return. Not that they're going to do that, but they could. For them, mitigating taxes, wealth transfer, rising generation leadership, family dynamics, and wealth preservation, quote unquote, asset protection. I mean, protecting the castle with the moat, those are going to be most important to them. I've covered some solos lightly, but I've covered on how some of those families create offshore private banks, offshore, speaking of insurance, but captive or reinsurance companies. And for sure, again, PPLI came up all the time. And I think for the reasons that you're hearing here, it simply could be an incredibly powerful structure and vehicle from a variety of different perspectives. Again, we could probably do a 6 to 8 hour masterclass, and it may still be complicated. So trying to cover it in 1 hour is almost impossible, but I'm really glad that I had a chance to do it. I'm going to have a closing comment in a second, but why don't I kick it off to Brad? Brad, for those that have an interest in learning more about you and your organization and wanted to follow up, how could they do that?
So thank you, Angelo. They could certainly visit our website, which is privateriskcapital.com. That's privateriskcapital.com. They can email me at bbarros@privateriskcapital. I start by reading up on PPLI, but the audience should understand that most of what they're going to read is sort of that commercial broker-centric product, not the bespoke, curated product that we, alongside of a team of attorneys, including some of those you've mentioned, are going to custom create for the client. But that's a great start, and we'd be delighted to. We typically will work with clients to give them a pretty deep understanding of the metrics, the performance, how well we're going to really move the needle on a project before the client needs to make any sort of commitment. So they get to understand what the frictional costs are going to be, and then have a measured decision on whether to move forward.
A very good point. And if you could give your email address one more time, Brad.
Sure. It's B Barros. It's B like Brad, Barros, spelled B as in boy, ARROS, at privateriskcapital.com.
Excellent. And Brad and his amazing team with Lewis and Steve and others are really some of the true thought leaders in this very complex community. Well, this has been really a lot of fun. Not many people could say that about a life insurance and tax-centric conversation, but how I find my fun, hey, what can I say? I guess I'm unique. So I'm Angelo Robles. I'm the host of the Angelo Robles podcast, Apple, Stitcher, Spotify, iHeart, and other platforms. Founder and CEO at FamilyOffice Association, a global membership organization dedicated to families of great success and their family offices. Our members get access to our near daily meetings, our private subscription newsletter, our master classes, to some level, me and my connectivity and my relationships and connections. We do have a significant series of master classes that are just starting to go up. Technically, we rolled out the first one yesterday. It's one of the biggest. It's a 6 hour plus masterclass on video. If you go to my website, FamilyOfficeAssociation.com, we're also going to be hosting it on some other platforms like Teachable. We have Family Offices 101 going up in about a week. They'll be on Udemy. I'm excited to be on their platform, as well as my website. My members get this all comped. It's all part of their membership package. But for those that aren't and don't want to be, then there's one-off opportunities in terms of purchasing. And more work, for what I noted already, what I've done this summer, in terms of consulting on creating a family office or adapting into a resilient and anti-fragile family office. I'm really excited. I've been discreetly doing that for about a year, but I'm more public with doing it now, but have very, very limited capacity. I'm incredibly busy with Family Office Association and the membership organization, but these kind of passions around wealth preservation, offshore, and all the uniqueness that makes up the art and science of the family office community is invigorating to me. You could find me on social media. I'm Family Office on YouTube, very active on Instagram and LinkedIn as well. FamilyOfficeAssociation.com, the website. Angelo at FamilyOfficeAssociation.com is preferred email. Everyone, thank you so much to our live audience and those that view or listen to this, and a special thank you to our wonderful guest, Brad Barros. Brad, thank you so much.